How do estate taxes work after someone dies? Imagine a loved one has just passed, and now the question is what happens to their assets and how taxes fit into the picture. When someone dies, their estate, which includes cash, property, investments, and other assets, is valued at its fair market value on the date of death. This total is called the gross estate. From this amount, certain expenses and debts like mortgages, funeral costs, and taxes are deducted. These deductions help arrive at what is called the taxable estate. The taxable estate is then combined with any taxable gifts the person made during their lifetime, starting from the year 1977. This total determines if estate taxes are owed. The federal government only taxes estates if their value exceeds a specific exemption threshold. For 2025, that exemption is $13,999,990 per person. If the estate is below this amount, no federal estate tax is due, and the estate usually does not need to file a tax return. If the estate exceeds the exemption, the estate must file a federal estate tax return, known as Form 706. The estate then pays a tax on the amount over the exemption at a rate of about 40%. The executor, who manages the estate, is responsible for filing this return and paying any taxes owed. This payment is made from the estate's assets before distributing anything to heirs. In addition to federal taxes, some states have their own estate or inheritance taxes. These vary widely in rules and thresholds. Some states do not have these taxes at all, while others may tax smaller estates or impose additional taxes on heirs. Understanding estate taxes is especially important for African American families planning for retirement and legacy. Because estate taxes can reduce what is passed down, using strategies like trusts, lifetime gifts, and charitable donations can help lower taxes. This kind of planning helps preserve wealth and build a stronger financial foundation for future generations. Executors also need to handle final income tax returns for the deceased and any income the estate earns during administration, such as from rental properties or investments. Managing estate taxes carefully ensures that more assets go to heirs and less is lost to taxes. In summary, estate taxes are based on the value of the estate after deductions, with high exemption limits that mean most estates do not owe taxes. Proper planning and administration can help reduce the tax burden, making sure that wealth is protected and passed on smoothly. This is especially vital for African American families working to grow and safeguard their legacy for generations to come.